For years, investors have been told that silver is just an industrial metal, a forgotten asset sitting in the shadow of gold. But what if the biggest opportunity of this decade has been hiding in plain sight? What if the forces building beneath the surface are far stronger than anyone realizes? Today, we're going to examine a prediction that has stunned even seasoned market veterans: silver reaching 240 per ounce. This isn't about hype, it's about supply shortages, monetary instability, industrial demand, and a market structure that few people truly understand. The evidence is mounting, the trends are accelerating, and the window of opportunity may be closing faster than most investors think. The question is no longer whether silver can surprise the world. The question is whether you're prepared for what comes next. When most people think about silver, they focus almost entirely on price. They watch the charts, follow the headlines, and react to every move up or down. What they often fail to examine is the fundamental force that ultimately drives every commodity market over the long-term: supply and demand. The reason this matters so much today is because silver is facing a supply deficit that has been building quietly for years, and the majority of investors still do not fully appreciate the implications. A supply deficit occurs when the amount of silver consumed by the world exceeds the amount of silver being produced and brought to market. Unlike temporary shortages that can be solved quickly, persistent deficits create pressure that accumulates over time. Inventories begin to shrink, available stockpiles become tighter, buyers compete for fewer ounces. Eventually, the imbalance reaches a point where price becomes the mechanism that restores equilibrium. The silver market is unique because it serves two very different functions simultaneously. First, silver is a monetary metal with thousands of years of history as a store of value. Second, it is an industrial metal used in a vast range of modern technologies. This dual role creates a situation where demand can come from investors seeking protection from financial uncertainty, while industrial consumers continue purchasing silver regardless of market sentiment because they need it for production. For decades, many people assumed that silver supply would always be abundant. After all, silver has been mined throughout human history and has long been considered more common than gold. However, what matters is not how much silver exists in the Earth's crust. What matters is how much can be economically extracted, refined, transported, and delivered to the market each year. One of the most overlooked realities is that the majority of silver production does not come from primary silver mines. Most silver is produced as a byproduct of mining operations focused on other metals such as copper, zinc, lead, and gold. This creates a significant limitation on supply growth. If silver prices rise dramatically, mining companies cannot simply double silver production overnight because their operations are often driven by the economics of entirely different metals. Imagine a copper mine that happens to produce silver as a secondary product. Even if silver prices surge, the mine's production decisions remain heavily dependent on copper market conditions. This means silver supply lacks the flexibility that many investors assume exists. The market cannot rapidly increase production in response to higher prices, especially in the short term. Another challenge facing silver supply is the declining quality of ore grades. Across the mining industry, companies are often extracting lower concentrations of metal from the ground compared to previous decades. This means more rock must be processed to produce the same amount of silver. Higher costs, greater energy requirements, and increased operational complexity all place pressure on future production growth. The mining industry also faces a serious timeline problem. Discovering a new silver deposit is only the beginning. Once a discovery is made, companies must conduct extensive exploration, feasibility studies, environmental reviews, permitting processes, infrastructure development, financing arrangements, and construction projects before a mine can begin producing metal. In many cases, this process takes 10 years or longer. This delay creates a structural issue. Even if the industry suddenly recognizes the need for substantially more silver production, the response cannot happen immediately. The market must wait years before new projects contribute meaningful supply. During that period, demand continues to grow while existing mines face natural depletion. Many existing silver mines are aging. As mines mature, production often declines. Operators must work